Okay, so let's just recap. So if there's a greater than 50% likely chance that you're going to lose this lawsuit, you have to do a journal entry and a footnote disclosure. But what happens if they say, well, the most likely amount that I'm going to lose is $1 million, but there's a range between $500,000 and $5 million, but the most likely amount is $1 million. Then what you would do is you would debit contingent loss, credit contingent liability for the $1 million, and then you would disclose the range of the loss between $500,000 and $5 million. But that's if you come up with the best estimate. What happens if they say, well, I think I'm going to lose between $500,000 and $5 million, but no number is better than any other number in that range? Then what you would do is you would just book the minimum of the range, you debit contingent loss and credit contingent liability for $500,000, and then you would disclose a range for $500,000 to $5 million. So if you have no best estimate within that range, you book the minimum of the range. If you have a more likely number than any other number within the range, you debit and credit for the most likely number, and then you disclose the entire range. Now, if something is only reasonably possible, which means it's more likely than remote, but less than probable, then all you have to do is disclose the fact. What happens if it's remote chance, which is greater than 0, but less than reasonably possible? Then all you have to do is nothing. All right, you do nothing, except for when you act as a surety or a guarantor. For example, when you factor your receivables with recourse. If you factor your receivables with recourse, you're basically guaranteeing the debt of your customer to the factor because you sold them with recourse to the factor. So if your customer doesn't pay the factor, then the factor can come against you to get paid by the dead instead of having the deadbeat customer, all right, pay. So when you act as a surety or a guarantor, a surety basically means that they just miss a couple payments and the bank has to come against you immediately, as opposed to as a guarantor, they miss a couple of payments, they burn down the collateral. Let's say the house was a collateral. They burn down the collateral. Then they abscond to the Bahamas. They look all over for them and they can't find them. Then they come against you. That's basically the difference between the surety and the guarantor, how much work they have to do to go find that debtor before they come against you, the person who co-signed the loan, okay, or who's guaranteeing the debt. So it's not very much work they have to perform in a surety, but they have to perform much more work before they can come against you when you're acting as a guarantor, all right? It doesn't matter when you act as a surety or a guarantor on someone else's debt, such as when you sell the accounts receivable with recourse. It doesn't matter if the likelihood of loss is remote, reasonably possible, or probable. You still have to book a journal entry where you have to debit some sort of a loss and credit some sort of a liability. Specifically, the journal entry when we sold receivables with recourse was a debit a bad debt expense, which is similar to this, and credit a recourse obligation. And a recourse obligation is a form of contingent liability. Okay. The other type of contingent liability they like to do is they like to ask about warranty expenditures. In the middle of page 288. They talk a little bit about warranty expenditures. All I want you to know about the warranty expenditures is this. You have a T account called warranty liability. The warranty liability is a contingent liability. It's going to have a beginning balance. To that, you'll add the adjusting journal entry. This is the adjusting journal entry for warranty expense. This is usually done as a percentage times sales. From that, you'll subtract your warranty expenditures. The warranty expenditures are actually the costs you are incurred, the costs that you incur in order to make good on that warranty, in order to comply with the warranty. For example, if you sell a blow dryer, blow dryers, they have like a warranty of like 60 days, And what happens is that you can either send it in to have the blow dryer fixed, or they'll just replace it. So when they honor that warranty, if they're going to replace it, what they will do is they will debit the warranty liability and they will credit inventory if they replace your blow dryer. Or if they're just going to fix it, they're going to debit the warranty liability and they're going to credit cash because they have to pay somebody labor costs to fix it for you. All right, so that's what you're doing here with the warranty expenditures. Those are the expenditures incurred, the company incurs in order to honor the warranty. And then you're going to have the ending balance. Please remember that the adjusting journal entry has to comply with a matching principle. When you comply with a matching principle, you match the entire amount of the warranty expense to the sales that are made in that accounting period. So it doesn't matter if, like, you see all these cars, you buy a new car, and the new car has a 10-year powertrain warranty. Even though the warranty is for 10 years, the total amount of the warranty expense is recognized in the year of the sale in compliance with the matching principle. The reason that you do that, and you have to take the entire warranty expense and match it in the year of the sale, is because they understand that warranty expenses are selling expenses. The reason is because nobody will buy that car unless it has a good warranty. So the warranty is a selling point about the car. And any cost that you incur to increase sales, such as giving a very good warranty, such as a 10-year powertrain warranty, is called a selling expense, and you have to match the entire amount against sales revenue. So it gets matched in the same accounting period in accordance with the matching principle. Okay? Let's just take a look at how tricky that can be. Let's take a look at multiple choice number 95, please. Number 95. Then we're going to take a look at some other multiple choice questions for contingent liabilities. Number 95 is found on page 302. Please take a look at number 95 on page 302. Number 95 on page 302 says, what amount should GUM report as an estimated warranty liability in its December 31st, 2009 balance sheet? So they want the ending balance in the warranty liability T account. During 2008, the GUM company introduces a new product carrying a 2-year warranty against defects. The estimated warranty costs relating to dollar sales are 2% within 12 months following the sale and 4 months in the second 12 months following the sale. Sales and actual warranty expenditures for the years ended December 31st, 2008 and 2009 are as follows. They have sales of 2008 of $150,000, in 2009 $250,000. Then they have the warranty expenditures, which happened on the debit side, of $2,250 in 2008 and $7,500 in 2009. They want to know what amount should GUM report as the estimated warranty liability in its December 31st, 2009. Do not be fooled by this. The actual warranty costs are going to be a percentage times the sales. The percentage that you have to use is the 6%. It's the 2% plus the 4%, because you must recognize the entire warranty expense in the year of the sale. And the journal entry that you will make is to debit the warranty expense, which is a selling expense, and you're going to credit the warranty liability for 6% times the sales. That's what makes this so tricky. So let's see what we can do with this. During 2008, GUM Company introduces a new product carrying a 2-year warranty against defects. So the beginning balance will be 0 because this is a brand new product. The estimated warranty costs related to dollar sales are 2% within the 12 months following the sale and 4% within the second 12 months following the sale. Okay? Sales and actual warranty expenditures for the years ended December 31st, 2008 and 2009 are as follows. For the sales, for the warranty expenses, to do my adjusting journal entry, which is a percentage times the sales, I'm going to take 6% times 150,000. So 6% times 150,000 is going to give me 9,000. And then I'm going to have, that's for 2008, and then my warranty expenditures in 2008 are $2,250. So that would be a debit to warranty liability and then a credit to cash or credit to inventory to replace the item. Then for 2009, it would be 6% times the sales in 2009 are $250,000. So 6% times $250,000, that's going to give me $15,000. And then the warranty expenditures for 2009 are $7,500. So all I have to do then is calculate the ending balance, which is the beginning balance of 0, plus $9,000 for my warranty expense for 2008, plus $15,000 for my warranty expense for 2009, minus the $2,250 for my 2008 warranty expenditures, minus the $7,500 for my 2009 warranty expenditures. So that's going to give me $9,000 plus $15,000 minus $2,250 minus $7,500. That's a total of $14,250. That's my ending balance. So let's answer the question. Number 95 says, what amount should GUM report as the estimated warranty liability in its December 31st, 2009 balance sheet? The answer is the ending balance in the warranty liability account is $14,250. So the correct answer there would be D, like David. What if they ask you, what is the amount of the warranty expense for 2009? The amount of the warranty expense for 2009 is $15,000. What if they ask you, what is the amount of the warranty liability at the end of 2008? The amount of warranty liability at the end of 2008 would be the $9,000 minus the $2,250, which would be $6,750. But that would be the balance in 2008. They wanted the balance for 2009. So the correct answer there would be D, like David, $14,250. All right, let's see if we can take a look at some other multiple choice questions here. Let's see if we can find some lawsuits. Let's take a look at multiple choice number 77. Oh dear. Number 77, which is found on page 300, please. Number 77 on page 300. Number 77 says, in Sims, December 31st, 2007 financial statements, which were issued on March 25th, 2008, how should this item be reported? On January 17th of 2008, an explosion occurred at the Sims Company plant, causing extensive property damage to the area buildings. Although no claims have yet been asserted against Sims by March 10th of 2008, Sims management and counsel concluded that it is likely that claims will be asserted and that it is reasonably possible Sims will be responsible for damages. Sims management believed that $1,250,000 would be a reasonable estimate of its liability. Sims' $5 million comprehensive public liability policy has a $250,000 deductible clause. So thank goodness they have good insurance, right? But the deductible is $250,000. In Sims' December 31st, 2007 financial statements, which were issued on March 25th of 2008, how should this item be reported? Okay, once again, like in auditing, this is called a subsequent event. The subsequent event occurs after the balance sheet date. The balance sheet date in question here is December 31st, 2007. The subsequent event happens on January 17th of 2008, where they have an explosion. And then the financial statements were issued on March 25th, 2008. Because this did not happen during 2007, okay, because we did not have this happen in 2007, there is no way possible that we would have a journal entry associated with this. However, because it is a subsequent event, it occurred after the balance sheet date and before we issued the financial statements, then what would happen is we would just have to disclose this. And when we disclose it, all right, the only time we would ever even possibly have a journal entry is if it was probable and it happened on December 31st, 2007 or before, within that accounting period, okay, because the accounting period cuts off at December 31st, 2007. But we do have to put a subsequent event footnote, all right, and what we would do is, would it be letter A, an accrued liability of $250,000? No. The only time we would do an accrued liability is if this event happened on December 31st, 2007. The event did not happen in 2007. It happened as a subsequent event on January 2008. All right, and then also we'd only record a liability if it was probable. In this case, they're only telling us it's reasonably possible. So is it letter B, like Barbara, a footnote disclosure indicating the possible loss of $250,000? That's what we would disclose. It would be a footnote disclosure as a subsequent event, and we would only say the amount that we could lose, and the amount that we could lose would be the amount of our deductible for our insurance, and that's because we think it's reasonably possible that we could lose $1,250,000 and our deductible is $250,000. Now take a look at answer C. Answer C is a footnote disclosure indicating the possible loss of $1,250,000. We can't lose $1,250,000 because we're going to get indemnified by our insurance company. And then answer D says no footnote disclosure or accrual is necessary. No, folks, you would have to do a disclosure at the very least. Your auditors would require it. So the best answer for number 77 is B, like Barbara. For number 77 is B, like Barbara. Let's take a look at multiple choice number 79, please. Number 79. Multiple choice number 79, please. In number 79, it says, it's also on page 300, it says, in its December 31st, 2008 balance sheet, what amount should Steele report as the liability from the lawsuit? Oh dear, everybody's always getting sued. It's just so depressing. That's because Americans are litigious. If you ever want to know why generally accepted accounting principles measure, they make a joke about this. They say international financial reporting standards, the international standards that they're thinking about converting to in 2011, all right, The reason that they're only 2 inches thick, let me tell you why. Because, first of all, this is generally accepted accounting principles. They laugh about it. It's 9 inches thick. Okay, this is my current text. It is 9 inches thick. You know why it's 9 inches thick? Because everybody gets sued, and after they get sued, they write a rule or a law for it. Okay? The Europeans, they started International Financial Reporting Standards. They don't care too much about suing. Okay? Not only that, they haven't been around for as long as generally accepted accounting principles have been around for. So the longer you've been around for, the more you get sued and the more rules you write. Anyway, that's just an editorial. It won't be on the CPA exam. Americans are litigious. Okay, number 79 says, in its December 31st, 2008 balance sheet, what amount should Steel report as liability from the lawsuit? On February 5th, 2009, an employee filed a $2 million lawsuit against a steel company for damages suffered when one of Steel's plants exploded on December 29th of 2008. Oh, my dear. So the factory exploded on December 29, 2008, and I guess the employee got injured, and they finally got some wherewithal in the hospital to start suing them on February of 2009. Anyway, because the event that led to the lawsuit happened in December 29th of 2008, you might have to do something for 2008, okay? Steel's legal counsel expects the company will lose the lawsuit, okay? So it's probable that they'll incur a loss, and estimates the loss to be between $500,000 and $1 million. So this has a range, $500,000 and $1 million. The employee has offered to settle the lawsuit out of court for $900,000, but Steel will not agree to the settlement. It is December 31st, 2008 balance sheet. What amount should Steel report as liability from the lawsuit? Well, we can see that it's probable that they're going to lose. They're telling you they're going to lose, okay? And they think they're going to lose between $500,000 and $1 million. The thing is that that's a range of $500,000 to $1 million. Is there one number within that range that's better than any other number? The answer is no. What about the $900,000 number that the employee has offered to settle out of court? Well, no, we're not agreeing. So that you take that $900,000, that's just there to confuse you, so you throw that out. So because it is probable, we're going to have to do a journal entry, and the journal entry we'll do is debit a loss and credit a contingent liability. Now, what would be the amount of the debit and the credit? Well, we would have to then say the minimum would be the minimum of the range, which is $500,000. So we debit the loss, credit the contingent liability for $500,000, and then we would have to disclose a range of $500,000 to $1 million in the footnotes. Okay, so the best answer for this would be in its December 31st, 2008 lawsuit, 2008 balance sheet. What amount should Steel report as liability from the lawsuit? The answer would be D, $500,000. Now, what if they said Steel's legal counsel expects the company will lose the lawsuit and estimates the loss between $500,000 and $1 million, but $700,000 is the most likely amount. If they told you that $700,000 was the most likely amount, then you would debit the loss and credit the contingent liability for the $700,000 and then disclose a range of $500,000 to $1 million. But because they didn't tell you one number was better than any other number in that range, they didn't tell you a number was any better than any other number, then you just book the minimum amount of the range, which is $500,000. So the best answer for number 79 is D, like David. Okay. Now, is there anything? Yeah. Okay. Number 85. Now, on the flip side of this, okay, we understand that when we did Module 7A, which was accounting theory, and we talked about conservatism, and conservatism is the accountant, when confronted with alternative methods of accounting treatment, do I recognize a loss or do I not recognize a loss? Would always, all right, that's the answer we're trying to answer here, okay? That's the question we're trying to answer. Do I recognize it or not recognize a loss? We'll always select the method which does not overstate assets and does not overstate net income. So we would recognize the loss. Isn't that right? Okay. Well, how about the flip side of it? We were being sued in those last couple of multiple choice. Now it's the other side. We're doing all the suing, okay? Because somebody's getting sued. Someone else is doing the suing. Well, the thing is this. You have to be conservative. I'm sorry, my nose is itching because I have so much stuff on my hands. And there's like marker everywhere. Anyway. So now we're doing the suing. So what does that mean? Are we allowed, let's say we win. Well, the answer is, do we really win? Well, it depends. The thing is, just because you win doesn't mean that they can't appeal. Because many times what happens is you win in a lower court, but you're the plaintiff and you win. But then the defendant kicks it up to a higher level court, like the Court of Appeals. They could really keep kicking it up all the way up to the Supreme Court. And then you'd have to win in the higher level court. So you really haven't won anything unless, they decide they're not going to appeal. So when you win, are you going to debit a receivable and credit a contingent gain? So are you going to debit a receivable and credit a contingent gain? And the answer is it depends. You can only debit a receivable and credit a contingent gain as long as they will not appeal. If they're still going to appeal, you really haven't won anything. And oh, by the way, even if they're not going to appeal, let me tell you folks, winning is not the same thing as collecting, okay? Because when you debit the receivable and you credit the contingent gain, when you debited that receivable, you might have to record an allowance for doubtful accounts on that receivable because you may not collect it all, in which case you would have to debit a bad debt expense and credit allowance for doubtful accounts on that receivable. So remember, you cannot record a contingent gain unless what? They have exhausted all their appeals and they do not plan to appeal. Then you can record a contingent gain for the amount that they will not appeal. If they're still going to appeal it, you haven't won anything. Let's take a look at a multiple choice question on that. Multiple choice number 85. We're almost done with this. Multiple choice number 85. Number 85 is found on page 301. Number 85 is found on page 301. Number 85 says, in its 2008 financial statements, Hayes should report what amount of a pre-tax gain. During January of 2008, the Hayes Corporation won a litigation award for $15,000 that was tripled to $45,000 to include punitive damages. The defendant, who is financially stable, has appealed only the $30,000 in punitive damages. So they have not appealed the $15,000. Hayes was awarded $50,000 in an unrelated suit it filed. You know what that means? Don't deal with Hayes. He'll sue you. Hayes was awarded $50,000 in an unrelated suit it filed, which is being appealed by the defendant. Counsel is unable to estimate the outcome of the appeals. In its 2008 financial statements, Hayes should report what amount of pre-tax gain, only the amount that is not under appeal, which is the $15,000. They can debit a receivable and credit a gain for the $15,000, which is not under appeal. So the correct answer there would be A. Now, what Hayes could do is they may be allowed to disclose the $30,000 amount, and they may be allowed to disclose the $50,000 amount, but they can't make it seem like they're really going to win because they really don't know. Okay, so they may be allowed to disclose it, but they have to be careful, and they can't make it seem too positive. So the best answer for number 85 is what should they report for the amount of pre-tax gain in their financial statements would be $15,000 would be the contingent gain. So the best answer for 85 would be A, the $15,000 amount, which is not appealed. All right. There's just a couple more items in here. I want to talk to you about compensated absences. On page 290, we have compensated absences, which is about 1 inch from the top of the page. Page 290, compensated absences at the top of the page. It says compensated absences. These are things like holiday pay, sick leave, annual leave. In particular, annual leave and sick leave. That's what they mean by the compensated absences. On page 290 at the top, compensated absences. Knowledge of the conditions that must be present in order to accrue a loss contingency is helpful in accounting for compensated absences. That is vacation pay and sick leave pay. According to standard number 43, an employer shall accrue a liability for employees' compensation for future absences if all of the following conditions are met. First bullet. The employer's obligation related to the employee's rights to receive compensation for future absences is attributed to employee services already rendered. That means the employee has already earned the sick leave and they have already earned the vacation leave. Okay? Second bullet. The obligation relates to rights that vest or accumulate. Now, something that vests means that you can take it with you. So if you leave the company, you take it with you. They have to pay you. If something accumulates, that means you stay at the company and you can carry it from year to year to year. So it carries forward from one accounting period to another accounting period. That's what accumulate means. The payment of the compensation is probable, so it's probable that you'll have to pay, and the amount can be reasonably estimated. What they're saying here is that the bare minimum of what you have to book for a compensated absence is the amount that vests. Now, it's nice to book an expense and a liability for what accumulates, but the bare minimum is of what you have to book is what vests. absence. All right, let's take a look at a multiple choice question on this. Multiple choice question number 90, please. Number 90. Number 90 is on page 301. Number 90 on page 301 says, in its December 31st, 2008 balance sheet, I'm looking at number 90 on page 301, North's employees earn an average of $100 per day. In its December 31st, 2008 balance sheet, what amount of liability for compensated absences is North required to report? Okay. Now, the minimum that you have to report on your balance sheet is whatever that vests. Vest means if your employee leaves, they have to take it with you. Okay. Now, accumulate means they just have to carry it from one accounting period to another accounting period. You're not required to book the part that accumulates, but you are required to book the part that vests. Number 90 says, North Corporation has an employee benefit plan for compensated absences that gives employees 10 paid vacation days and 10 paid sick days. Both vacation and sick days can be carried over indefinitely. So if they can be carried over indefinitely, that means they both accumulate. Employees can elect to receive payment in lieu of vacation days. However, no payment is given for sick days not taken. What they're saying is that the employee's vacation days vest, but the sick leave does not vest. It just accumulates. At December 31st of 2008, North's unadjusted balance of liability for compensated absences was $21,000. North estimated that there were 150,000 vacation days and 75 sick days available at December 31st, 2008. North's employees earn an average of $100 per day. In its December 31st, 2008 balance sheet, what amount of liability for compensated absences is North required to report? They're only required to report what vests, and the only thing that vests is going to be their vacation days. So how many vacation days do they have? They have 150 vacation days. So you take 150 vacation days, you multiply that by $100 per day, and that will give you the $15,000. The $15,000 is what you have to report in your liability account. So this is then your compensated absence liability. And once again, the balance would have to be the 150 days times the $100 per day, which equals $15,000. And that's what they wanted, was the ending balance. Now, I know they told you that the beginning balance was $21,000. So what do you do with the $21,000? Well, that's just there to help you calculate the adjusting entry. The adjusting entry would actually be to debit the liability account for $6,000, and you would credit the expense for $6,000 because you would reduce that liability. But the thing is, they didn't want the adjusting journal entry. They wanted the ending balance. The ending balance has got to be the 150 days times $100 a day, which is the $15,000. So why they put the $21,000 there? Just to confuse you. Now, if they asked you what would be the amount of the adjustment, you would debit the compensated absence liability of $6,000, and you would actually credit the expense for $6,000. That's because in a prior accounting period you overstated the expense. That's why it's too high. So let's take a look at number, 90? Yeah. Let's take a look at number 90 and answer the question. Number 90 says, North's employees earn an average of $100 per day in its December 31st, 2008 balance sheet. What amount of liability for compensated absences is North required to report? You're only required to report what vests. You do not have to report what accumulates. So the correct answer would be $15,000. The correct answer there would be D, like David. It's one of those little nitpicky rules that they have. All right, the very last item is something that's new and has to do with standard number 159. If you please turn to standard number 159 on page 290. It appears at the very bottom of page 290, letter D. It's about 3/4 of the way down the page. It's the fair value option. Letter D says, as discussed in Module 7D, SFAS number 159 provides that, I'm on page 290, about 3/4 of the way down the page, letter D, the fair value option. As discussed in Module 7D, SFAS number 159, which is the fair value option, provides that a company can elect the fair value option for reporting financial assets and financial liabilities. The fair value option also applies to firm commitments that would otherwise not be recognized at inception that only involve financial instruments. Non-financial insurance contracts and warranties may only be reported at fair value if the obligation can be settled by paying a third party to provide the goods and services. So what they're saying is that if you have a warranty liability, that you can pay a third party to honor that liability for you, then you're allowed to carry that warranty liability at fair market value. Okay, let's see if we can take a look at a multiple choice question on this, and we'll end on this. That would be multiple choice. By the way, this is brand new. Okay, didn't have this last time. Multiple choice number 97, please. Number 97. Number 97 is found on page 302. Number 97 on page 302 says, at what amount should Lute record the warranty liability on the balance sheet? The Lute Corporation sells furnaces that include a 3-year warranty. Lute can contract with a third party to provide these warranty services. I'm looking at number 97 on page 302. Lute elects the fair value option in SFAS number 159 for reporting financial liabilities. At what amount should Lute record the warranty liability on the balance sheet? Is it letter A, the cost of expected warranty services? No. How about letter B, the present value of the expected warranty cost? No. How about letter C, the fair value of the contract to settle the warranty services? That's it. All right, the best answer there is C. It's the fair market value of the liability. Take a look at answer D. The fair value of the contract to settle less the cost to provide services. No, it's the fair value of the entire contract to sell the warranty services. The best answer for answer number 97 is answer C. The fair value of the contract to settle the warranty services. Remember, it's the fair value of that warranty liability when you can pay a third party to assume the warranty for you. All right, so the best answer for number 97 is C. Remember, you have to do simulation number 1. Simulation number 1, you only have to do reporting requirements only. Remember, in simulation number 2, you do have to do the entire thing, all right, for simulation number 2. For the communication portion of simulation number 2, all you have to do is read, all right, the question and then read the solution, read the answer. Remember, for doing research, they do provide a topical index, but it's arranged just like the current text. It's about financial instruments. Where would you find anything about financial instruments? Under where? Letter F for financial instruments, right? Remember my 15 keywords? Review the 15 keywords for me, okay? And then I'll see you then in module 11A. Okay, I'll see you in 11A. Bye.